Good morning, everybody. I hope you all can hear me loud and clear. Can I get a thumbs up? Yes, you can hear me.
Yes.
Thank you so much. All right. Thank you so much, guys, for making time in January. Schools just opened and you have prioritized this webinar. I really do appreciate it. So I'm not going to waste your time because we've got a lot to cover and very little time. Okay. Cool. So just what's on the agenda for today? We're going to go through a couple of housekeepings. I'm going to do some introductions about myself, and then we're briefly going to go through the financial statements. What I want us to focus on today are the questions, the burning questions that I got with regards to how to read financial statements for small businesses. And if you stick around until the end, we've got not one, but two gifts for you. So please do stick around. Okay, cool. All right, this webinar will be recorded and the slide decks will be provided upon your request. So please just send us an email at sales@ndzumoconsulting.co.za for any recordings. However, you can also check out any webinars that we've hosted on our YouTube channel under Ndzumo Consulting. Cool. So what I'm going to do is briefly introduce the financial statements for small businesses, and then I'm going to dive into the questions. So I'm just going to I'm going to have one request. If I can just finish going over the financials before your questions come in, because it's quite important for me that I go through the financial statements briefly, and I'm going to spend more time on the questions that you have. So a little bit about myself. I consider myself to be a risk taker and a problem solver. Also what I've been told. I am a registered accountant with SAICA as well as a tax practitioner with SARS. I run a company called Ndzumo Consulting where we help small businesses pay little to no taxes legally, of course. But we also provide bookkeeping, payroll services, as well as advisory services, as well as coaching when needed. I'm a mother of four, so December was not a holiday. It's now that I need a holiday, now that the schools are open. I'm sure a lot of you can relate to that. My why. Why did I leave the comfort of corporate to venture into this unshaky or shaky world of entrepreneurship? It was mainly because of a personal story of a company-owned business that started the fire within me to help small businesses who are great at what they do. But the finances side of their businesses is not their strongest point. So that's where I then decided to focus on helping small businesses in the area where they might not be their strengths. What I hope for you from this webinar, I don't think there's anything I'm going to say today that is completely new. But what I hope for you is that you take at least one thing that you hear today and actually use it when you're reading your financials, right? And see if does that help you better understand your financials. If you can just hold on to one thing today from what you've learned here and actually use it when you're reading your financials, that would be an achievement on my side. Okay. Tandi Sizwe. Yes, you've raised your
Yes,
hand.
ma'am.
Yes.
Yes, I can hear you, ma'am.
Yes. Go ahead.
What do you want? Do you want me to introduce myself?
No. I'm just introducing myself. We're not going to have time, unfortunately, to introduce.
No. I was, I didn't raise now. I was just
Oh,
raising my hand.
Okay.
Raise.
Not a problem.
Yes.
Not a
Okay,
problem.
thank you.
Thank you. Sure. Okay. This is quite important that we clear this. What this webinar is not about, right? This webinar is not about turning business owners into accountants in 30 minutes. I am good, but not that good. So accountants probably did an undergrad for 4 years at a tertiary institution, then spent another 10 years in practice. My job on this webinar is not to try to convert business owners into accountants. That's not at all what I'm trying to do. The second thing that this webinar is not to show business owners how to read financial statements like an accountant would in 30 minutes, right? Now, this is what this webinar is about. This webinar is to briefly introduce business owners to financial statements and how to read them, okay? To also elaborate why financial statements are important for business owners. That when you get the financial statements from your accountant, you don't just put them in your drawer and forget about them. Those reports are there to add value to you so that you can find out how your company performed in the last 12 months. Then the focus of this webinar will be on the questions that you business owners have always had about financials, but were either too afraid to ask your accountant, or questions where you felt like, surely by now I should know what the answer is to this because I have been in business for so long. Or dare I say it, stupid questions, which there aren't any, by the way. It's just for me to help you address those questions that can make you feel a little bit more comfortable about the reporting that you're getting from your accountants when it comes to the financial statements. Okay, let's dive right in. What are financial statements? In a nutshell, financial statements are financial reports that tell you how your company performed over a certain period of time. So some financial statements are run over 1 year or 12 months. Some financial statements are run over 2 years or 24 months. So it's the reports that you get to find out how your company performed financially over a certain period of time. Now, there are 3 reports that I want us to focus on that make up financial statements. Let's get into an example and I'll show you what I mean. Okay, can I get a hands up? You should be seeing an Excel spreadsheet with financial statements in green. Can everybody see that? Thank you, Ernest. Thank you. All right, cool. So there are 3 reports that I want us to focus on with regards to the financial statements. The first one is called the Statement of Financial Position, commonly known as the balance sheet. The second one is called the Statement of Comprehensive Income, commonly known as the income statement. The last one is the cash flow statement. Okay, let's dig into these reports. What is the balance sheet? The balance sheet is basically a report that gives you a brief overview of how the company is performing at a particular point in time. So it's a report that tells you a couple of things. One, what the company currently owns, which is what we refer to as assets. 2, who the company currently owes money to, which we refer to as liabilities. The third thing is what's called equity. Equity is basically the shareholders' ownership of the business, right? Equity, another way to look at it, it's what the value of the company is. So if an investor wants to invest into your company, they will look at equity to see how much is this company worth as a starting point so that they can get an idea. Another way to look at it is if you were to sell your business, when you look at the equity, that's a starting point to indicate how much your business could be sold for. But like I said, that's just a starting point. There are other things that are considered when you are buying or selling a company. Now, the three major components that make up the balance sheet is the assets. Assets are broken down into what's called non-current assets and current assets. Non-current assets are assets that the company owns, but are going to stay with the business for more than 12 months and longer. So it's things like property, plant, and equipment. So any vehicles that you might have, any buildings that you might have. If it's an asset of the company and it's going to stay for more than 12 months, then we put it under non-current assets. Long-term investments are just some of the examples. Then we've also got what's called current assets. Again, assets are things that the company owns, things that belong to the company. Current assets are assets that will be turned over or converted into cash within about 12 months. Things like cash, the cash in the bank, or your debtors. Those are examples of current assets. Then I'm just going to come back to the equity. Then we've got liabilities. Liabilities, again, are things that the company owes to other people. So examples of liabilities would be long-term loans to like a bank, as an example, or short-term loans like to creditors, or even SARS if you have not paid your VAT. Okay,
Like
so that's
me.
what the balance sheet covers. In summary, the balance sheet is a snippet of what the company is currently worth at a particular point in time. We look at the assets, you look at the liability, and what the equity is. Next, we go into the income statement, which is also known the statement of profit and loss. Now, the income statement can help you answer a number of questions. How much sales did the company make over a 12-month period? How much money was spent on cost of sales? Cost of sales being the cost you had to incur in order to make that sale. How much money was spent on operating activities within the business? How much money was spent on rent, paying employees? Those are part of operating expenses. That's what the profit and loss will answer for you. Right? Another thing that is included in the statement of comprehensive income is how much tax you are likely to pay. Okay. Then we've got what's called the statement of cash flow. The statement of cash flow basically looks at the cash, the movement in the business. Cash is king. We all know that. There's the saying that goes, turnover is vanity, profit is sanity, but cash is reality. Without cash in the bank, no company can actually be able to function. So a question that I normally get asked is, what's the difference between the income statement and the cash flow statement, right? So I'll give you an example. Let's say you raised an invoice to a customer of 900,000, right? And then, so in your income statement, you'll recognize the full sale. You'll create an invoice for 900,000. However, if the customer only paid a deposit of, let's say, 50%, then in the bank, you only recognize half of that, which is the 50%, which is the 450,000. So the cash flow statement looks at the actual cash that came in and out of the business, whereas the income statement looks at the sales, the expenses, but on what's called the accrual basis of accounting. So meaning that you could have raised an invoice, but not necessarily have received the money for that invoice, but we still recognize the sale in full, even though you have not received the money for that invoice. So that's why there is this third report, which is the cash flow, which looks at the cash in the bank. All right. So the statement of cash flow will look at things like how much money came in terms of your sales, how much money came out when you were buying inventory, employment costs in terms of cash out of the bank. Then we look, and then it will tell us that your cash either increased or decreased during the period. So when you look at the opening balance of the cash versus the increase in the bank over the period, this should be the closing balance for the cash, right? Now, here are a couple of tips, because I've had this question where it was asked, how can we ensure that review it at an overall level as a business owner? How can I ensure that my financial statements are accurate? So there's two things you can do. The first thing is ensuring that the balance sheet balances. Now, how do you ensure that it balances? We said that assets are things that the company owns. Liability are the things that the company owes to outside people. So equity is what's left in the business. So how you can check is if you take your total assets minus your total liabilities, the balance should be equity, right? If when you take the assets minus the liability, the total is not equity, then your balance sheet is not balancing. Therefore, whatever your accountant has given you is not correct. That's the first thing. The second thing you can check is with regards to the cash flow. So when it says at the bottom here, net cash at the beginning of the year. So if the beginning of the year for you is the 1st of March, you can go look at your bank statement balance on the 1st of March to see what the balance is. And then you also look at the closing balance. So you go to your bank statement and you look at the closing balance of your bank on the 28th of February and see if it amounts to that amount. If it does not amount to that, then your financials are not correct. Take them back to your accountant to resolve it. Don't accept it until these are agreed to what's in the bank statement. Okay. I'm going to end there and open time for questions.